Hi everyone, I'm Karunya Rao, and on Ideas for Profit today we discuss the investment prospects of Mass Financial. It's a small NBFC that primarily focuses on four product categories: micro enterprise loans, SMEs, two-wheeler and CV loans. The company also has a housing finance subsidiary that caters to affordable housing segment. The company has a unique distribution model of revenue sharing with NBFCs. This provides better last mile connectivity and underwriting as operational and credit costs both are shared. The year gone by was subdued thanks to management's conscious strategy to go slow on disbursement and focus on collection instead. Higher provisioning on account of COVID and excess liquidity on the balance sheet, along with slight pressure on asset quality, resulted in suppressed interest margins despite benefits of lower cost of funds. Now, like I said, FY21 was a difficult year for Mass Financial as the lender to smaller businesses and mostly self-employed individuals found the going tough due to pandemic-induced lockdowns. Amid the challenging macros, this risk-averse lender went shy on expanding its books, leading to a decline in AUMs. The excess liquidity on the balance sheet and deterioration in asset quality impacted interest margin, and weaker than normal asset quality and unexpected rating downgrade of one of the NBFC partners warranted additional provisioning. But despite these setbacks, balance sheet quality has improved. The company has manageable NPAs, excess provision and adequate capital as well as liquidity. The company had gone extremely slow on disbursement in the wake of COVID. Disbursement in Q1 was a paltry 108 crore, picked up to 820 crores in Q2, then 1031 crores in Q3 and accelerated to 1294 crores by Q4. But the second wave of pandemic will be a speed breaker as growth will take a back seat and could resume only in the second half at the earliest, as this wave has impacted rural areas as well. The 10% YOY decline in assets under management was contributed by key constituents, micro enterprise loans along with two-wheeler loans. While growth was missing and it will remain absent for some time, we still feel the company is well prepared to restart its calibrated growth once the crisis abates, as it has managed its house well so far. Mass experienced some trouble with one of its NBFC partners in the second quarter and it fully provided for it. The overall collection efficiency touched 95% in Q4, but it was down to 92% in April and it's likely to be much lower in May. Restructuring was minuscule at 0.3% of advances and has been granted only to borrowers who have the ability to repay. The company carries COVID provision of about 56 crores that can be somewhat provided or seen as a buffer in the coming difficult period. We also expect at the same time provisioning to be elevated in FY22 as well. The company is well funded, carrying the liquidity to the tune of 1,000 crores, and the funding mix continues to be diversified. It has managed to bring down the blended costs of funding by 30 basis points sequentially by the end of March 2021. Mass is also a comfortable capital adequacy ratio of 26.9% with Tier 1 at 24.8%. As I flagged off earlier, Mass has a housing finance subsidiary which is into affordable housing category. It perceives housing as a key growth driver, but of course it was cautious on lending in FY21, which led to stagnation in the loan book. Although the asset quality was quite steady, it held up well. The company has very high level of capitalization and it is carrying excess provision to the tune of about 3.5 crore odd, which is about 1.25% of its on-book assets. The pandemic is undoubtedly a speed breaker and FY22 is also likely to be a subdued year. However, with better quality of balance sheet, it will be a winner in the competitive landscape post the pandemic. We also draw comfort from the stated objective of pursuing calibrated high-quality growth with a hawk eye on asset quality. Seen in this context, the current dull phase of the stock has driven the valuation down to the IPO level, which was seen in 2017. It merits attention for gradual accumulation. We feel the impending stress is an opportunity to add the stock for the long-term investors.